Welcome to our webinar focused on investment fundamentals. Our speakers today are Multnomah Group Principal Scott Cameron and our Senior Consultant David Williams. Both are members of our investment committee. A few housekeeping items before I let the guys kick off the webinar. All of the attendees are on mute, but if you have a question, please put it into the Q&A feature in your control panel for Zoom, and they will address the questions at the end of the presentation. We are recording this webinar, and you will receive both a recording of today's presentation as well as the slides. You should receive that in the next couple of days. With that, I will hand it off to Scott.
Great, I appreciate that, Lindsay. And thank you everybody for taking the time to join us today. I know it's, as we approach year end, it can be a busy time for everybody, and I appreciate everybody taking some time to learn about investment fundamentals. One of the things that we wanted to kind of touch on as we go through this is kind of the need that we've seen with our clients to provide ongoing education for plan fiduciaries. And this is the first of what is a curriculum that we've put together as a firm on topics related to plan management that is relevant for fiduciaries. And so I hope that you find this relevant and that you keep an eye out for future webinars that we're going to be hosting as we head into the new year on a variety of different fiduciary education topics, as well as for those clients that are on the webinar today to know that this is curriculum that we really put together with the hope of incorporating it into our regular quarterly meeting cycles to make sure that as fiduciaries to our plans that we're staying on top of all the issues that are relevant to us today. So with that, I'm going to turn it over to David to kind of kick us off and walk through, and we'll talk a little bit about some of the fiduciary responsibilities, some of the terminology we see with investments, and some of the processes we think that are important for plan fiduciaries to understand as it relates to investments in their plan.
Great, thanks, Scott. So starting on slide 2, the Department of Labor requires that employers educate their committee members on their roles and responsibilities. So our hope is by the end of this discussion today that you walk away with an understanding of the responsibilities of committees for selecting and monitoring investments within the defined contribution plan, the differences between an investment strategy, management technique, and investment style, and then understand some of the quantitative and qualitative tools that are used to monitor investments. We move to slide 3. First and foremost, kind of some of the key responsibilities that committee members have with regard to investments are, first thing is that committee members aren't expected to know everything. I think that's an important starting point under ERISA, is that where you lack expertise, you're expected to hire third parties to help you fulfill those monitoring responsibilities, as well as helping facilitate decision making. Some of the key responsibilities that we see and work with clients on with regard to investments is, first and foremost, we follow a prudent process. We'll talk more about that process that we help clients utilize in a bit, but some of the other issues that we'll do is if you have an investment policy statement that ERISA doesn't require an investment policy statement, but the expectation is if you have one that you go ahead and follow it. Committees have the responsibility to determine the structure of the investment menu. This includes ultimately the number of funds, but how the funds are presented to participants in the types of tiering and structure that is used to communicate the different investment options to participants. You're going to have to select the investment options. You have to select not only the default investment options, but also the core funds, whether those be active or passive, if they be broad asset classes or very specific asset classes. And then you need to monitor at regular intervals the underlying performance of the investment options and determining whether or not new asset categories need to be added. You'll notice on the right-hand side here we have a couple of pop-out boxes that are referencing other materials. As Scott mentioned, this deck is part of a larger effort. And so you will see, as we work with clients over the next couple of years, additional topics that will be explored. And this is just a reference point to some of those other areas for future discussion. If I move you to slide 4, ERISA, the body of law, is really about process and following a documented due diligence process for the decisions, as opposed to being judged on, did you pick the best fund? Did it perform the best relative to all other candidates? We really, our goal is to help clients, follow a prudent process. And this slide really just describes how we work with clients with regard to investments. So we'll start with on the right-hand side, upper right-hand side, gathering relevant information. So with investments, this is, trying to understand the demographics and utilization of those investments by plan participants. And then we'll go ahead and analyze that information to determine if the new option or the existing options are suitable and are being utilized in an appropriate way. Continuing around the wheel, we meet with you, the committee, as well as the committee gets together and analyzes and discusses the information to ultimately make a decision. And then you complete the wheel by documenting the process, maintaining good meeting minutes and materials that were reviewed that ultimately, provide evidence that evidence for the decision that you ultimately made. We'll move forward to slide number 5. For the next couple of pages, what we're going to do is explore some common investment terminology that's used by investment managers. And the goal here is to just provide a little bit of a education for our committees, but also demystify a little bit of the terminology that's used within the investment management industry. We probably won't remove all confusion, but hopefully we start to provide a little bit more clarity about some of the different terms that are used. If we start at the top level from a strategy standpoint, we viewed 2 types of investment strategies offered to plan participants in DC and defined contribution plans. First is active, the second is passive. An active investment portfolio is seeking to outperform its designated index, and the fund manager is going to utilize information to buy and sell securities that produce a portfolio that has, ultimately different characteristics in the index, with the intent that they are going to provide a level of outperformance for that different portfolio. The fund fees that the managers charge tend to be higher than index funds, and that's really designed. I mean, the justification is that there are resources required, whether that be people, research, and other systems that are required to run those actively managed funds that are in addition to a passively managed fund. The other type of a strategy is passive, or commonly referred to as index funds within the industry. These funds seek to track the performance of its assigned index. So the goal here is not to outperform, let's say it's a US large cap equity fund, and the fund is tracking the S&P 500 index. The goal is that it performs very closely to the S&P 500 index with no real surprises to either the positive or the negative side. Fund fees tend to be lower because there's not a lot of additional research that's required, expense associated with analyzing the underlying securities. I can move you forward to slide number 6. So we've talked about strategies. Now we'll step down one layer and talk about different investment management techniques that are common within the defined contribution market. From an active standpoint, and this is by no means an exhaustive list, but within actively managed strategies, there are kind of 4 common techniques that are used by investment managers: fundamental, technical, and then a top-down and bottom-up. And these techniques can be combined. You can have a manager who uses a bottom-up fundamental strategy, or one that uses a technical and combined with a top-down strategy. So this is technique, excuse me. But these can be combined. So a fundamental manager is going to be analyzing the specific details of the underlying securities to determine if it's if the security is priced fairly, and if it's lower than their expectation for its valuation, then they may buy it. If it's higher, they may decide to sell the security. So they're going to be analyzing things like cash flow expectations and dividends and growth in earnings and so on and so forth. Another technique is technical. Not commonly used within defined contribution plans, but there are some managers that will use it. And these managers using this technique are selecting securities based on historical pricing or trading patterns. And so, it is a strategy that's utilized, but we don't see a lot of this particular technique. Then the last 2, top-down and bottom-up. Top-down managers are going to be looking at what's going on at the overall economy level and determining, is the U.S. growing vis-a-vis other countries? Are certain sectors growing faster than other sectors? And they'll overweight or underweight those particular securities or sectors based on those macroeconomic views. Whereas the converse is the bottom-up manager, where they're going to be analyzing individual securities and picking stocks or bonds based on the underlying characteristics of those securities. So you think of it as, hey, the technology sector is doing really well, but a bottom-up manager may not have any technology stocks because they're looking and seeing that the best priced stocks or best growing stocks from their investment research process are in different sectors. On the bottom, we talk about a couple of passive techniques. First is replication. So these are, index funds that use replication are creating a portfolio that holds each security within that index in its proportional weight within the index. So this is very common for like an S&P 500 index strategy, where it's a relatively small number of securities. The securities have plenty of trading volume. It's a relatively easy index to replicate. The other technique is the sampling. There's a series of sampling techniques, and this is done with indexes that either have a lot of securities or securities that are thinly traded, commonly done in maybe some non-US equity indexes, potentially some quite often within US bond indexes that just have a lot of securities. And so what they'll do, the fund manager will try and replicate the major characteristics. So in the bond, in a bond fund, instead of owning all 5,000 securities, they'll own a subset that match the major risk characteristics of duration and credit quality and so on. So it's a way to gain index-like exposure but not own all the securities. The major difference between the two is we expect the replication technique to have lower what we call tracking error relative to the index. So less volatility or less return differential from the index. Sampling technique sampling technique funds can end up having a little bit more tracking or a little more volatility performance difference relative to the index. If I can move you forward to slide number 7. We'll finish up this discussion with investment management styles that are common in defined contribution plans. We'd look at, from an asset class standpoint, kind of the 2 major asset classes we see in DC plans are equity and bonds or fixed income. Within the equity space, there are 2 major styles commonly discussed are growth and value. Portfolios that are growth oriented or seeking stocks that have above average growth metrics, whether that be above average earnings, above average revenue, or there are other ratios, but really looking for stocks that are growing underlying fundamentals faster than the market. And then the opposite there is value. The value style tends to be characterized by selecting stocks that are undervalued or cheap relative to the general market. They may have improving fundamentals, higher earnings, expectations for earnings to increase, but for whatever reason, the market has them priced below what a fund manager is calculating their expected future stock price to be. On the bond side, I see two major styles, core and core plus. Fund managers that are categorized as core are investing really in investment grade securities that are primarily U.S., that are located in the U.S., offered by U.S. issuers. And those are, government bonds, corporate bonds, various asset-backed or mortgage-backed securities with that are all investment grade. Managers that are active, that go into the core plus style, utilize those same segments of the bond market that core managers utilize, but also opportunistically invest in a quote unquote plus sector, which can be high yield, so below investment grade securities, as well as international securities, whether those be issued by issuers from developed markets or emerging markets. And so they will use those segments of the market to add incremental value over the long term for their investors. With that, I'm going to hand it back to Scott to talk about committee responsibilities with regard to investment monitoring.
Great, thank you, David. As David mentioned at the outset, ERISA is really focused on prudent process, and one of the primary responsibilities of any plan fiduciary is to select and monitor the investment options that are made available within their investment menu for their plan. And as we look at what a prudent process for investment monitoring looks like, it's helpful to understand, I guess, some of the components that go into that. And as we look at a high level, we tend to split it between certain quantitative tools that we have available to us and some of the qualitative work that we think is important to be doing from a fiduciary perspective in monitoring the investment options. And so as we talk about quantitative tools, these are the things that I think probably most committee members, most plan fiduciaries are familiar with. It's looking at measures of strategy or fund performance, both on an absolute basis, how is a manager or product done over the past quarter, 1 year, 3 year, 5 years, 10 years, and also looking at it relative to some different metrics, like relative to a benchmark that's been chosen or relative to peer groups. That basic level of kind of monitoring, I think, is pretty broadly done by most plan fiduciaries. But we know there's also additional tools that are available to us to get more information to understand performance. Things like performance attribution, using either returns-based style analysis models or holdings-based style analysis models to evaluate what the drivers of performance are. Are they overweights or underweights to certain sectors or segments of the market? Are they stock selection within those sectors? What was it that drove performance during a given period for a manager, either positively or negatively, and using that attribution to understand, why the manager behaved the way they did, as well as using measures of risk-adjusted performance, looking at the volatility of the manager, measures like tracking error, which is really the volatility of their excess returns relative to their benchmark, trying to provide a risk adjustment to better understand the portfolio. Those quantitative tools are pretty commonly used by plan fiduciaries, by investment consultants. We also think it's important to use some qualitative judgment and due diligence, understanding the firm that's managing a portfolio, who the people are, what their investment philosophy is, their process they use for building their portfolio, the specific portfolio construction process and rules and guidelines that they have in place, and how they manage risk. Using those two sets of tools, the quantitative kind of performance-based tools and the qualitative assessments and judgments of a manager, is really the key to, I think, implementing a prudent fiduciary monitoring process for the investments in your plan. One of the things we talked about was on the quantitative side, using benchmarks to measure performance. So a benchmark is, it's really just a point of reference against which an investment manager can be measured. Most of the time, the benchmarks that we're using are public indexes from a variety of different providers. We think there are certain characteristics that make a benchmark a good benchmark. Things like, we pick it in advance, so we're not kind of cherry picking the results after the fact, that it's an appropriate representative construction for the manager that we're using. So we're not using, an S&P 500 index fund, which is large cap US stocks, to measure a manager that invests mostly in small cap emerging market stocks. That's not appropriate. Obviously, it needs to be measurable so that we can get the data to compare it. Hopefully, it's unambiguous, it's clear what it is, and that it reflects the opportunities that are available to our managers. It's not helpful to have an index that isn't investable, isn't reflective of what our managers could actually do. But many times, almost always, when we're looking at the performance of an investment manager or an investment strategy, one of the things we're going to do is compare it to an appropriate benchmark index. There's a few different major index providers out there, names that you may see or hear about. There's S&P, Standard & Poor's, Dow Jones as an index provider. Their method of creating indices is a little bit unique. They have rules-based indexes, so they can create, some prescriptive rules that basically say securities that meet these requirements are included in the index. They also have some committee-driven indices where there's a committee that gets together and makes selections. You probably saw yesterday the Dow was down 800 points. The Dow Jones Industrial Average is a committee-driven index. It's not a great benchmark for active managers, although it's published frequently. There's a committee that basically picks the 30 stocks that go into that index. S&P, Dow Jones, generally that index family is used primarily for domestic equity, U.S. equity funds, things like the S&P 500 index. They also have some target date fund benchmarks and some real estate benchmarks that are commonly used. Another fund family or index family that you may hear about is the FTSE Russell. The FTSE is the Financial Times Stock Exchange They acquired Russell, which is an index provider kind of focused here in the U.S. A rules-based index creation primarily, and Russell is in many ways kind of the leading or dominant provider of U.S. Equity indices. So you'll commonly see managers that choose to compare themselves against the Russell 1000 index, which is large cap stocks, or the Russell 2000 index, which is small cap stocks. They also have a value and a growth component to those. So that's a pretty common fund or index family that's used for U.S. equity strategies. MSCI is another major index provider, similar rules-based methodology. They were really the ones that initiated international indices, and that continues to be where they're dominant in the market. So you'll see a variety of different international benchmarks from MSCI, but they're probably most commonly used among active managers for their benchmark. MSCI also has some ESG indices, so environmental social governance. As that becomes more common and more of interest, they're creating benchmarks and indices in that space as well. On the fixed income side, if you go back 15 years, Lehman Brothers was the kind of the leading provider. That index fund family has kind of gone through a few transitions. It went to Barclays in the financial crisis. It was acquired, and now most recently Bloomberg's acquired it. As David mentioned, fixed income it creates kind of a unique set of challenges from an index perspective, both trying to create the indices as well as trying to implement index strategies that based on those indices. But Bloomberg, Barclays is a large index firm that you'll commonly see used as benchmarks for fixed income portfolios. So in addition to using benchmarks, which I would say tend to be, from my perspective, kind of our primary measurement tool, you'll commonly see manager universes or peer groups used in evaluating benchmarks. So a manager universe or a peer group is really just a collection of investment strategies, all with a similar investment objective. Probably the most well-known is the Morningstar category system. Their creation of kind of the style box-based approach, where you have large value and large blend and large growth and mid-cap and small-cap components of that. There are other systems out there to categorize managers. Lipper has them, and others have them. But the idea is really to create a collection of investment strategies with a similar style in how they invest, that invest in similar securities, and use that as a peer comparison to evaluate the manager. Generally, I would say manager universes, peer comparisons are a better kind of secondary performance measure, but there is always a tendency for us as investors to want to kind of compare ourselves to what others are doing and what the opportunity set of other options are, and that's really where peer groups and manager universes come in. If we're selecting an active manager, from my perspective, it's important to understand whether they're adding value relative to kind of the passive benchmark. But we also then frequently want to see, how well are they doing on that metric compared to other peers? So if everybody in the universe is outperforming, are they still beating their peers, or are they lagging behind? It's a common thing that people want to understand. Manager universes certainly have limitations, and hopefully as we go through this and talk about this, there's not one, you'll come to the same conclusion we have, which is there's not one single kind of metric, one single thing that you should be looking at. A couple common kind of limitations with manager universes is there's no adjustment for risk. And so, some managers within a defined peer group can take very different levels of risk within their portfolio. And when you're doing peer comparative analytics on performance, you aren't necessarily adjusting for that risk in evaluating managers. Manager universes also suffer from survivorship bias. Any type of peer data, there is over intermediate to long periods of time, unsuccessful mutual funds quite frequently liquidate and close or merge with other products. And so looking at peer universes and not accounting for the fact that, you know, there was you're only looking really at the products that have survived over the window you're evaluating is a limitation of them as well. A couple other limitations I would point out is, you know, depending on the asset class, you can have varying levels of how homogeneous the strategies are. For example, large cap growth as a peer group is pretty consistent. Managers investing in large US companies with their view of growth. But you can also then go to a category or a peer group like World Bond, and if you're using Morningstar's categorization system as an example, you can get quite a wide variety of options within that peer group. You can have funds that hedge or unhedge their currency or partially hedge. You can have funds that invest in sovereign debt and corporate debt or some combination of both. And so peer groups, you know, sometimes are not that successful in kind of matching exactly a manager is chosen strategy. And so it's something that I always kind of caution plan fiduciaries to understand is the limitations of peer group or manager analysis. As I mentioned, quantitative tools are pretty commonly used across plan fiduciaries, across providers. It's very easy generally to have past performance and other kind of quantitative tools, data to look at, but there's limitations. One, they rely primarily on past performance. That may not be predictive of your future experience for a variety of different reasons. One is past performance generally isn't a great predictor of future performance. Two is past performance may not be reflective in some cases of the current manager or their strategy. It's also dependent on the analysis window and choosing the right benchmark. As I mentioned, it can happen that there are you know, benchmarks used that aren't appropriate from time to time. For example, managers that, you know, choose a broad benchmark like the S&P 500 when they're investing in small cap stocks and not large cap stocks, or they're using a benchmark in the international space that doesn't have emerging markets, but they're putting, you know, 20 to 25% of their portfolio into emerging market stocks. Proper benchmark selection is really important in using those quantitative tools. As we look at prudent monitoring, this is an area that, you know, I think we try and caution all of our clients against being too reliant on purely quantitative tools in making decisions. And most frequently that pops up as an issue when we look at investment policy statements that put in place very prescriptive quantitative metrics that the funds that they use in their plan are required to meet. So we've seen metrics like performance has to be in the top half of its peer group on a 3 or a 5-year basis, or it has to have a Sharpe ratio, which is a measure of risk-adjusted returns above average in its peer group. These tools are good to use, but we don't believe that they should be the only or in even many cases kind of the primary decision-making tool that plan fiduciaries use in monitoring or selecting the investments in their plan. Instead, we tend to view kind of a focus on kind of the qualitative judgments as more important in understanding a product. And this is true for the selection process before hopefully you add a fund or a manager to your investment menu, but it's also true of the ongoing monitoring. To understand this and to continue to monitor this is important. And as we look at this, you know, what are those qualitative things that we think we should be evaluating? First is the firm. How's the firm ownership structured? Is it a large publicly held company? Is it a small boutique with a primary owner? Is it a partnership? Is it a subsidiary of a larger financial institution? Ownership structure, there is not a right or a wrong, but understanding that structure can help us understand where there may be challenges or opportunities that are unique to that structure. And how does that structure promote continuity? You know, one of the things that we'd like to see is investment teams that are stable and experienced and don't have unnecessary turnover. Ideally, from the top down, you see that from the ownership and how the business has been structured. And then what is the assets under management trend? You know, revenue in the investment management space is driven by assets. We'd like to see a certain threshold of assets to understand that there's sufficient resources there to manage a product. If we're seeing a very high growth, we know that that can create some limitations in terms of the ability for a manager to add alpha or value in their strategies. If we're seeing significant outflows, you know, that may be constraining the resources of an investment manager and limiting their ability to continue to manage a portfolio. Once we look at the firm, we then kind of look at the people and try and understand the structure of the investment decision-making team. So, you know, there's a variety of different investment management styles. You know, you can go back to the star manager system where you have a Peter Lynch or somebody like that who is kind of the single genius managing a fund. More frequently, we're seeing kind of a transition to a team-based approach, either a team working collectively or multiple individuals making decisions and being rolled up into a single portfolio, but understanding what the structure of the portfolio management team is, where the research is coming from. Some firms have centralized research teams that support all of their investment strategies. Usually this is with larger firms where they have manager or research analysts assigned based on sector. And the individual managers kind of work with those sector teams to generate research. In other cases, we see individual investment strategies build their own research team. So in a small cap growth strategy, for example, you may find there's a lead portfolio manager and a couple analysts that support that manager doing research. And we want to understand their qualifications, you know, where their education level, their experience level, you know, what qualifies them to be doing this, how long have they been doing this. Once we understand the firm and the people, then we want to understand the philosophy. Really, and this is kind of focused on active managers, you know, what is it that they believe gives them an ability to outperform the market? And how does that philosophy and that belief impact how they're going to construct the portfolio? You know, if we don't think that a manager has a unique ability to outperform, you know, we're not likely to want to use that manager because we're going to be paying high costs and getting market or below market performance. So we want to understand what that unique thing they have from a philosophical perspective that gives them an edge in outperforming. And then how does that philosophy translate to a process for research? What is the process that they go through to define what securities are going to end up in their portfolio? How do they generate ideas? How do they analyze those ideas and evaluate them? And then ultimately, who has responsibility and how is a decision made to add a security to their portfolio, as well as how to sell a security. That should be a pretty well-defined process that a manager is able to communicate to you as a planned fiduciary, and should give you some comfort, if well communicated, that those quantitative tools that we talked about, that past performance, is something that's likely to repeat. It wasn't a gamble or you know, some measure of luck that they outperformed, but they have developed a process that seems reasonable in being able to add value going forward. When we talk about portfolio construction, we're really trying to understand kind of how does that process translate to building a portfolio that they're managing. You know, there's usually some level of kind of rules that the managers put on their strategy or themselves. It starts with, you know, what benchmark are they using? How are they viewing their performance relative to a benchmark? And what constraints are they putting on themselves in a portfolio? For equity managers, do they tend to be fully invested or do they carry some level of cash? Do they have limits on how much cash in the portfolio they may create? Do they have either minimum or maximum position sizes? How large an individual security should be? Do they have any constraints relative to their sector of the benchmark? Some have absolute metrics, some have benchmark relative metrics, so we'll be within 1.5 times the sector weight of our chosen benchmark. And then what country limitations or regional limitations do they have? As I mentioned, do they invest in emerging markets or not? Do they have limits on how much? Do they have limits on what they do with currency exposure? Things like that. Those rules that kind of translate the process to how that portfolio may be constructed and defined. And then lastly, understanding how that manager looks at risk. How do they define it? How do they measure it? Who's responsible for tracking it? And what tools they have. It's really important for us to understand that mindset of how a manager views risk, to understand how that may impact a portfolio prospectively. Last thing I wanted to touch on is, we talked a little bit about some of the terminology that you'll see. David went through that with the investment styles, and we talked a little bit about that with benchmarks and peer groups or manager universes. The last thing I really wanted to kind of focus on was understanding the investment vehicle types that are available in defined contribution plans. For many plan fiduciaries, I think this is an area that's probably been overlooked, as there's probably historically been pretty much a focus solely on mutual funds within plans. But as we look, at a high level, you can see really 5 different types of products within a defined contribution investment menu. The first are general accounts. So these are insurance company contracts. They're regulated at the state level generally, and they're available to either retail or institutional investors. The traditional general account product is a fixed interest account. It's for companies, insurance company record keepers. It's usually included as the most conservative option. It doesn't fluctuate in principal on a daily basis, and it pays participants a fixed rate of return that can fluctuate over time based on what the insurance company sets that rate at. It's as mentioned here, a spread product, so it typically does not have an expense ratio attached to it. And instead, the insurance company makes money on the product by taking the funds that are invested in the general account fixed annuity, investing that with their other general account assets, hopefully earning a rate of return that is in excess of the rate that they pay out or credit to participants. Next category we have are mutual funds, pretty broadly used, governed by the SEC, lots of disclosure and prospectuses available in both retail and institutional investor groups, and clearly kind of traded in shares of mutual funds that are information's pretty publicly available, and you can have, as mentioned here, a wide variety of investment minimums and expenses. So you have retail funds that tend to be available kind of more broadly, have higher costs. We've seen a trend towards offering institutional investment mutual funds, either R6 or other institutional products that are generally targeted towards institutional investors, like defined contribution plans that are lower cost. And you can also have a wide variety of costs because you have active or passive index products here. Next group is variable annuities. These are again available primarily through insurance company-based record keepers. They look in a lot of ways like a mutual fund. In some cases, they're just a mutual fund wrapped in an insurance contract. The investments and fees can vary quite a bit based on the individual insurer, the size of the plan, the underlying funds, and the record keeping fees. The variable annuities also tend to have less publicly available data, but are commonly used in insurance company record keeping situations where that's kind of the preferred vehicle for the insurance company to record keep. And then the last two, I guess I would touch on commingled funds and separate accounts. We're seeing more and more interest. So commingled funds, collective investment trusts, CITs, are bank-regulated products for qualified investors like defined contribution plans. They're not governed by the SEC. They're instead governed by either federal or state regulators, depending on where the bank is chartered. and they have their own offering documents in lieu of a prospectus. They're very specifically limited only to institutional investors, and the advantages of them can be that they have lower costs because they don't have the mutual fund regulations. They don't also have the retail accounts servicing costs that are incorporated into them. They also allow for a little bit more flexibility in customizing the investment objectives. These are showing more and more interest in defined contribution plans because of the cost advantages and because there's been some back-end operational changes that have made them easier to record keep and across multiple record keepers. And data at the same time is becoming more available to them. There are some limitations on these types of commingled funds, specifically for 403B plan sponsors, that you can't use them. So it depends on your plan type whether they're a viable solution. And then lastly are separate accounts. So this is usually available only to the largest of plan sponsors because of the cost requirements. For small plans, it tends to be prohibitively expensive. For large plans, it actually can be very cost effective. But this requires more individual oversight and management from the plan fiduciary because you're going to an investment manager and creating a portfolio very specifically for your plan. The ownership is at a plan level, and you have insight into the underlying securities held rather than being in a pooled vehicle, which all the other products are, where you're in that same account with multiple investors. Separate accounts aren't that common in defined contribution plans because the cost of unitizing them so that they can trade daily in a defined contribution context. They're more common in other pooled institutional account types like pension plans, endowments, foundations, sovereign wealth funds, where you don't necessarily need to be able to translate the underlying assets into a net asset value on a daily basis so that participants can transact in that. But as you look at your investment menu, I think it is important to understand kind of the types of products that are there. Are they general accounts? Are they mutual funds, variable annuities? Because the oversight should vary a little bit. And as you select a manager, you should identify the strategy that you want to use. So that's particular large cap value strategy, and then from there evaluate the best method to get access to that. That could be in a mutual fund vehicle, it may be in a variable annuity, or it could be in a commingled fund. Understanding those different product types and what's available to you, I think, is important. And if that's information that's not available to you, we kind of tend to go back to one of David's first points, which is, work with prudent experts that have that knowledge and information to help you with that. With that, I'd like to turn it over to David to kind of wrap up and see if we have any questions here.
Great, thanks, Scott. So, as we conclude, our hope is that you come away from this discussion with a better understanding of your fiduciary responsibilities with regard to investments. Specifically, understanding that where you lack expertise, whether that be here on the investment side or in other functional areas of the retirement program, that you go out and you retain a service provider to help fulfill those responsibilities. Two, that there are two types of investment strategies, both active and passive, and that each strategy has different management techniques utilized by the underlying fund manager. And then finally, as with most things in ERISA, benchmark. Monitoring is really a critical component of that prudent process. And with that, those were our prepared comments, and we'd open it up for any questions.
As Lindsay had mentioned, we have everybody on mute for sound quality. If you do have a question, feel free to use the Q&A panel to submit that. I do not currently see any questions there. So with that, I guess I'll wrap up and say again, thank you for taking the time. I appreciate everybody spending this time with us to understand kind of the fiduciary responsibilities for monitoring investments. And if you do have any questions, certainly feel free to reach out to David or to myself or to any of the consultants that you may work with here at Multnomah Group.